Welcome back to Brian's Investments, where I show you how to make money while you sleep. I am not a certified financial advisor, so everything in this video is for informational purposes only. In this video, we're going to be talking about CDs, annuities, 401ks, Roth IRAs, all that good stuff about different investments that you can use to put your money into. Also, before we begin, go ahead and hit the like, subscribe, and notification bell in this video. When you get all three of them done, it'll actually unlock the rest of this video. Let's get started. Alright, let's talk about investing in CDs. No, not that kind of CD. So, certificate deposits. Basically, when you go to like a bank and you deposit funds into the bank, you draw interest on it, just like a savings account. Except right now the rate is about 0.5%, and they also have high deposits, $500, $2,500, things like that, like the minimum deposit. So if you put in $25,000 in a year, you'll make about $137. That's not a lot of money. I don't do it. I mean, if you're a millionaire, maybe that's great. You can get a decent amount back, but that's really low interest. And but they are safe for the most part. A lot of people use CDs just because it's a safer investment than anything else. Bond, James Bond. Alright, so investing into bond collectibles, James Bond memorabilia, no, I'm just kidding. So anyways, bonds is a lot more boring than that. There is callability, coupons, tax statuses, and things like that. So with bonds, you are giving money to a company or the government and saying, here's my money, do what you want with it, but I'm going to charge you interest on it. You're almost acting like a bank, and so they basically pay you for whatever you lend them. So a short term would be 1 to 3 years, medium term could be 10 years, or longer term could be longer than that. And there is callability. They could pay off the loan early, and then you don't make as much. The coupon rate kind of just depends on what you come up with. Do they have the ability to pay it off early or not? So whatever rate that you charge. Their tax filing status, government is of course tax-free, and but then the other is non-government would be taxable, so it counts towards income tax and capital gains and things like that. So but the average rate is about 5 to 6% on that, so it's kind of lower. There are a lot of risk included in bonds, but basically bonds is just saying, here's my money, pay it back to me when you can, but I want extra money on top of that. Alright, next on the list is mutual funds. This is a pool of investors that invest their money into a mutual fund that is managed by a money collector. And it's similar to stock investing, and basically the person in charge of the mutual fund tries to get all these companies that they believe are going to be highly successful and bring a better return to its investors. Right now, I think the highest one I've seen is 45% return, which is quite good. I'd say some of the lower performing ones are in the 25% range. But getting into mutual funds, I think is a great investment, and just make sure you're getting into the right ones. Like right now with the current administration, oil and gas is kind of on its way out, and energy is a new thing. So you might want to get into electric vehicles and solar panels, and anything that's not plastic, reusable energy and things like that. There are other sectors that are also very popular. So a mutual fund is you and thousands of others are just pooling your money into something, and someone is handling your money for you and trying to get you the best return rate for all the companies that they have in that mutual fund. Alright, ETFs, exchange traded funds. It's very similar to mutual funds, and it works on the stock exchange. And basically, when you buy into an ETF, it could have 100 different companies under it, and you own a little piece of each one of those companies. And there is a small fee involved, but usually it's like if you invest $10,000, you only have to pay a few bucks towards it. But depending on the ETF, you could have a 10-15% return, a 30% return. It kind of just depends on if any of those companies are failing or doing well. It's going to change your ETF up and down. Something that some people like to do is set up a reoccurring amount. So say, once a week or once a month, put in $10 or something. So it just automatically deducts from your bank account and just keeps investing into an ETF. Then look at it, 5 years later, and your little by little investments, as it just keeps going up and up and up, you'll have a way higher return that way. They do, come with some risk, just like anything on the stock market, but they are highly popular, and it's always good to have a couple in your portfolio. Let's talk about annuities. So this is something that's like a retirement plan that you invest your money into little by little, month by month, over time, and then this is called the accumulation phase. And when you hit a certain age or when your contract begins, it starts paying you out, similar to like Social Security or something like that. And so if you put in $100 a month every month, and say, at age 30, time you get to like age 65, they'll be paying you a fixed income of say $1,000 a month. And so it's a financial institution is what is holding your money and giving it to you little by little. You can't just say, give me all my money, or I want a different thing. There's a contract that you're under, and they just give you multiple streams of income that way. So basically, you're saving for retirement. There are different ways to do it. I probably will never own an annuity, and I would rather put my money into something like a Roth, but it's an option that's out there. Ooh, the big one, the stock market. Something that I'm heavily invested in, and it comes with its risk. It's something that could pay you very little or lose you a lot of money or make you a millionaire. You never know where it's going to go. So the thing with the stock market is you're investing into a company, and that company is using the funds to grow or to pay off debt or to buy back their shares, anything like that. So you're kind of helping that company out. If you invested into, Disney or something like that, or, GM, something that that's not going to go away anytime soon, it's a really safe investment. However, if a stock is $100 and that company starts having some problems, lawsuits, or, COVID, things like that, that stock could drop to $50. That does not mean that you've lost that money. It just means that the stock is down. If you sell the stock, you lose money. If you hold on to it and it goes back up to $125, then you just made yourself a decent amount of profit. So there's different ones. There's growth stocks, which are up and coming companies. Generally, they're either small and beginning their growth stage, or they're brand new companies launching their IPO. And it's something that I like to invest in. I get a 500% return on some of those. But you never know which way they're going to go. There are risks to a growth company. They may overspend and go into too much debt and go bankrupt, But another one is speculative. People are saying, hey, this is what this stock is going to do. This is what this company is going to do. They have no idea, but they're just like, hey, I hope it happens. And they go around with all the hype and telling everybody, hey, invest into this, invest into this. And people don't do it, or they do it, and then it's a pump and dump, which means the stock shoots up high and then tumbles. And so you don't want to do that. But the good thing with the stock market is invest in ones that you trust. There's things like dividends that pays you out every quarter or bi-yearly or yearly. It's just the company giving you a little bit back extra. So those are kind of good. But unless you have $100,000 invested, dividends really don't pay a whole lot, because if you have $5,000, you might make, $5 in dividends, depending, maybe $20, kind of depending on whatever company that you're in. But I love the stock market. Right now it's in a bear market, which means the stocks are way down, but everything's on clearance. So buy everything that you can now if you want. Don't spend more money than you can. It's not it's gambling. So don't spend more than you can afford. But if you want to get into the stock market, definitely purchase some of these stocks that, notice that they used to be $50, now they're $5. But definitely follow current trends and do your diligence and know what you're investing in before you invest in it. And join the Discord channel if you want some hot stock tips, because we talk about them all the time there. Roth IRA. So Roth was originally introduced in 1997 by William Roth, and it's different than a traditional IRA. So it's a retirement account that you deposit money into. However, it's a pre-tax amount and it's tax-free when you withdraw it later on. The limit on singles is $140,000 and on married couples is $208,000. Means if you're making above that, you cannot contribute to a Roth IRA. The maximum a year you can contribute into a Roth IRA is $6,000 unless you're 50 or older, and then it's $7,000. These are really great because later on when you retire and you need money to live on, it's tax-free. So you don't pay income taxes, you don't pay capital gains taxes or anything like that. So I recommend everyone getting a Roth IRA. I'm soon going to be starting it myself. I'm already 37 years old, but I definitely got to get it going before I'm 40. So it's a great thing. All right, so 401k is when you're working for a company and the company matches your retirement funding. So basically, if you said, hey, $100 every week or bi-weekly whenever you get paid goes into my 401k, your employer will match that amount to help you. And when it comes time for retirement, when you withdraw that 401k amount, it's going to be taxed. However, there is a Roth 401k. And if you have a Roth 401k, then it's tax-free, which is really great. So if your employer is a great employer and they do a 100% match to your retirement fund, put in as much as that you comfortably can. If you're making $2,000 a week, throw in $500 if you can afford it. Don't put in too much where you can't live or have enough savings for any disasters that may happen. But whatever you can safely contribute to your retirement, definitely do it, because your employer is adding money to your retirement account for you automatically for free. Commodities. This is a physical product that you're investing in, such as metals, agricultural, livestock, energy, things like that. A physical product out there. It has an annual return rate of about 6.79% since 1970s. But so you're actually investing into a product itself, which is a little different than other types of investing. However, they do come with their rewards and risk. But do you really believe in the product? And right now with the whole energy thing and going electric, would you pour all your money into crude oil when right now that's kind of on a downtrend? I mean, would you pour money into gold? Gold historically has been going up in price. So that could be a good investment, but it's only a matter of time before gold drops out. You never know. So you have to really understand what you're investing in and really believe that the new trend is going to increase your profits on that commodity. Cryptocurrency. It's more of a millennial investing type thing. Started in 2008 with Bitcoin. So what is crypto really? Crypto is platform tokens, security tokens, transactional tokens, utility tokens, governance tokens. So when people think of cryptocurrencies, they think of a digital dollar. It's not really that. Each type of crypto has a different use. So platform tokens would be like Ethereum that has an ecosystem that a ton of companies and cryptos work under of their system. A security company could be for finding vulnerabilities and security issues in different types of products or the internet itself. Transactional tokens could be like PayPal and Square, and purchasing a product through smart contracts. Utility token could be like streaming, kind of like Netflix and Hulu and all that. Streaming, or a new type of internet service like satellite internet, like Starlink that Elon Musk has. So crypto is very volatile. So it can go up or down extremely quickly in a matter of minutes, hours, days. It can go up and down all the time. There's halving events. There's bull runs and bear runs. Most cryptos are on an upward trend. There's a lot of meme coins like Dogecoin out there that really has no use. It's just a funny coin that a lot of people invest in. Bitcoin's a store of value. Ethereum is an ecosystem. So different types of cryptos, are worth more than others. But I'm highly invested into it, and I do my due diligence, and I look at the coins and see what their trends and patterns are, and what their use is, and also who is the team behind it. I mean, when you have Google, Apple, Microsoft, Amazon engineers building a crypto, it makes you think, this is going to be a good thing. So look at the team behind them, see how well they're doing. Brand new cryptos that are a fraction of a penny are a bit risky, but they could also make you a billionaire. So a lot of these you could get a 200 or 300% gain in just a few months, or you could get a 200x return on your money in a couple of years, depending on when you get in. Even if you get in at a high point, just wait it out. Don't sell and panic if the crypto starts dropping. Just stay in it long term, and it should eventually go back up if it is a good token or coin. So yeah, I love the crypto market, and I'll be talking about it more on this channel. That's it on this segment of Brian's Investments. I have some guest speakers coming up and some near future videos that should be really good. And make sure that you hit the like, subscribe, and notification bell so you can stay up to date on everything in this channel. Thanks again, and let's make that money while we sleep.